Welcome to Alternative Investments Chat,
where we demystify the world of alternative investments and financing for entrepreneurs and investors alike.
With these discussions, we hope you're more empowered to unlock opportunities in your business or portfolio. I'm Erin.
And I'm Erica. Let's get started.
Welcome to another episode of Alternative Investments Chat. Today, we're going to be talking about undervalued alternative assets. So what does being an undervalued security or investment even mean?
Yeah.
It's interesting, right? So the core concept is that an undervalued investment's market price is below its actual intrinsic value.
Okay.
Intrinsic value is what an asset is truly worth based on the fundamental factors like your cash flow, assets, earnings, future growth potential, rather than just the market sentiment or that short-term fluctuation of prices.
Got it. So investors who believe in the concept of undervalued investments are often called value investors.
Ooh.
They see the value in things. I sometimes struggle with that. Working on it, okay? They seek out companies or assets that are traded below their perceived intrinsic, there we go. One mess up and we'll just get it right. Intrinsic value, hoping that the market will eventually recognize their true worth, leading to price increase. Cool. Sometimes we'll talk about it, but I can understand, like if you look at something, you're like, that's worth $5, and then you take it and they're like, actually, it's worth $25.
Right.
Like, woo.
Yeah.
You had no idea.
Exactly.
So what's that?
You're getting a good deal.
Exactly. So in other words, if an investment, it's an investment opportunity where the market is underestimated the potential of the asset, and therefore its price is lower than what would be based on future cash flows, growth potentials, or inherited qualities.
Yep.
So alternative assets can be a great place for value investors to look for new opportunities.
Yeah, absolutely. So let's dive into a little bit more about undervalued assets, and we'll talk about some examples here. So they exist both in the traditional and alternative markets. Cool. There are some asset categories that are actually more prone to being undervalued, specifically when it comes to alternatives, which of course is what this podcast is all about. So for example, real estate. I'm sure we all have heard about foreclosures, right? So foreclosures are often undervalued compared to the market prices due to being a foreclosed property. Also, distressed markets, these are areas that are experiencing temporary economic difficulties or challenges, or even a buyer's market. They may see undervalued properties. Buyer's market means buyer has the power. Their money can go further. They have a little bit of the pick of the litter. Also, renovation opportunities. Properties that require renovations are often sold underneath the actual market value, leaving an opportunity for appreciation. We'll talk a little bit more about that later. When it comes to commodities, there are supply and demand imbalances that can occur. Overproduction or geopolitical factors may lead to a temporary oversupply, which would mean that demand is low because the supply is so high, so the price goes down.
Maybe that's what happened to Beanie Babies. Maybe they just made too many. Maybe from our previous episode where we talked about that.
Yeah, they should have just kept it scarce.
There we go.
Also, cyclical price movements. Boom and bust cycles are common for commodities. They happen a lot. For example, oil prices usually drop during a global recession. So that's just something that we know is a typical outcome. Yeah. So prices can vary. Additionally, there can be an overreaction to short-term events. Can you believe it? People overreacting. Yeah.
I never would have believed it.
Yeah. So investors can have an overreaction to short-term news, which can deeply impact the current price, but not have an impact on the overall long-term value. Yeah. So that's something to keep in mind. Erica, can you tell me about some other asset classes and how they experience undervaluation?
So venture capital, believe it or not, also this happens there. So there's a lack of visibility. So many promising startups do not have widespread recognition, making them undervalued before they scale and attract attention. Right. Wasn't it the one a long time ago in one of our very first episodes, we talked about the Scrub Daddy?
Oh yeah, we talked about Scrub Daddy.
And so remind me, wasn't that one that nobody wanted and then all of a sudden it blew up and went crazy?
Scrub Daddy actually did really well. It was the Ring camera that nobody wanted.
None of the sharks wanted. So that one was definitely undervalued. And now look at it. They're on
almost everybody has like a
door.
Ring camera. Yeah.
I know you got to be careful. You can't walk and trip or anything. Someone for sure caught you on camera.
For sure.
So back to venture capital though. There's a misunderstanding of growth potential. So sometimes investors underestimate the growth potential of a new business or technology.
Right.
Again, just like that Ring cam, like they didn't realize that every single body was going to needs to like have eyes on everything, that we're, as a community, we like to spy on our neighbors.
Yeah, for sure. Imagine that.
Exactly. There's also funding shortfalls. So during economic downturns or uncertain times, funding for startups can be scarcer, leading to lower valuations, even for promising companies. So it might be a really good product, but people are like, nah, no one's going to like this.
Right.
So that sometimes stinks. Now, we also, collectibles, you kind of touched on them, can be undervalued as well because of niche markets. Mm-hmm. So investors may not fully appreciate the rarity or potential appreciation of certain collectibles or assets, leading to undervaluation.
Right.
Think about stuff you have in your house. Like, remember baseball cards? When we talked about that on episode.
Sure, like rare coins or, all sorts of things that people collect.
Artwork. I mean, what is the show? Antique Roadshow, where they you bring this old lamp and they're like, oh my gosh, it's worth millions. And they're like, oh, I was going to sell it for $5.
Me and my dad used to watch that on Sundays a lot.
I always hope that something in my house would be like that. But since I bought everything from, Home Goods, I highly doubt it.
Yeah, I don't think so. Not yet.
I don't think anything's going to be high valued. With commodities also, there's a lack of liquidity. So the difficulty of valuing and selling alternative assets can cause them to be undervalued, especially if there's a limited market activity. Again, if you don't know, you don't know, and people aren't going to buy stuff. And then lastly, there's overlooked assets. Many rare items are undervalued simply because they haven't yet caught the attention of broader investment communities, just like we talked about the baseball cards back then, but now they are. But when they do, their value can raise substantially. For example, raw desert land near fast-growing suburbs. So we'll talk a little bit more about Buckeye in a second. But think about Buckeye, Arizona. It appreciated significantly when infrastructure followed.
Yeah, exactly.
So who's going to buy this crap land
or perceived crap land, right? Like it's hard to get water there. So let's talk about it. Now that you brought it up, let's talk about it because we're gonna dive into some real life examples.
Yeah, let's talk.
So on August 28th, 2024, a company called Tract announced its acquisition of that land in Buckeye, Arizona. Is actually a 2,000-acre parcel, just over 2,000-acre parcels in Buckeye for $136 million. They acquired this land.
Got it.
So they will actually be turning this land, this desert land, into a $20 billion data park center, which is crazy, right?
Yep.
So they may, in the end, have up to 40 individual data centers when it's all said and done, which would make it one of the biggest data parks in the United States.
That's wild.
So you don't think about Buckeye, Arizona as being a hotspot for data centers or really being a hotspot for any sort of big land investments, right? In fact, some of our listeners may not have ever heard of Buckeye. It's not a place in Arizona that people know.
Not where they go travel and visit. They're like, I want to go to Buckeye for vacation.
Exactly. People know Scottsdale, people know Phoenix, people even know Sedona. Yeah. Buckeye's not one of those things.
They're not on the list.
But it actually is a perfect location for this type of infrastructure due to its vast space and its proximity to the Buckeye Airport. There's a really small airport out there.
I live here and I didn't know that.
Yeah, I know. And I didn't either.
I know. When I was reading our research, I was like, there's an airport there?
There's an airport there. So, even just goes to show, right? So the land was actually originally planned to be a residential community. So like a suburb where people can live. But the data park is actually a better fit because there's not a lot of water there. And so they would have to bring in a ton of water to the area. Because if you're thinking about people who live, you have to run your laundry, you have to run sprinklers, you have to take showers, you have to, run your dishwasher. Lots of water that is required in order for people to live. And a data park requires much less water.
Yeah.
So not only was this an undervalued investment in and of itself, but the development could bring other undervalued investments to the actual area. Property in Buckeye is currently cheaper than a lot of places in Arizona, including Phoenix and Scottsdale. You can get land out there for cheaper than you can in the more popular areas. So the development of this data park may actually change that as more jobs are created in the area, and that will increase or potentially could increase the demand for property out there, and also the need to develop that area further to be a residential area. So it's an interesting thing.
Yeah. Well, that's definitely something to look out for.
Yeah.
We already saw this happen in Silicon Valley. They would build these, Google and Apple have their campuses is what they're called, and they built them out there. And then all of a sudden, all around them are houses and apartments. So if that happens, there's going to be a lot of other things going up and people coming to this town. So that's crazy. So here's another example that is probably more familiar to our listeners. We're going to travel back, way back, not really, to 2008. I know.
I don't want to go there.
Trust me, I'm older than you, and I don't want to go there either. Most people remember this as being a terrible time, as the us from us suggest. But some people did take advantage of the distressed market, particularly in real estate.
Yes.
When everyone lost their houses.
Yes.
So during the global crisis, we saw property values plummet due to a lot of reasons, including the housing bubble, like I just mentioned, mortgage defaults, and overall economic downturn.
Yeah.
Unfortunately. So this led many properties being under-evaluated, especially in the areas where foreclosures were prevalent. We talked about the foreclosures earlier. So prices plummeted as much from 30 to 50% or more from their peak values.
Yeah.
Investors saw an opportunity to acquire distressed properties and at significant discounts. So again, people who didn't lose their house and didn't lose a bunch of money during this time, they saw these properties and went around and snatched them all up. So investors who could see past the short-term market turmoil recognized that these prices were not sustainable in long-term markets. So the market value would eventually recover, as we saw. Now it's not a buyer's market anywhere close to it. It's a seller's market here. And these undervalued properties they would appreciate over time.
Yep.
So as a broader economic recovery, or as the economy recovered, should I say, so did the real estate market.
Yep.
Okay. So by 2012 and 2013, real estate values in many of the distressed markets had begun to rise again. Again, we've already lived through this a few times and seen this. So properties that were purchased during the height of the crisis at deeply discounted prices saw significant appreciation. So for those investors, that was absolutely amazing.
Yeah. Yeah. And it's a great way for the people who could to turn lemons into lemonade. Obviously, not everybody was in a fortunate position to be able to invest in that way. Some people were just trying to hold on to their own house, let alone, trying to buy another one. But for those investors who were able to do that, definitely were able to generate some profit. Some investors also took advantage of the undervalued properties by buying them, making improvements like the renovations and repairs, and then selling them for profit. This is known as flipping. If you watch HGTV, I'm sure you watch a lot. There's lots of flipping shows out there.
It's only channel on at the nail salon.
Yes.
So I think that's what I always watched.
Yeah, and I also just really like watching those shows. So this was particularly profitable in those cities that had fast recoveries. If you think about a big dip, people would buy it, flip it, and then as the economy quickly recovered in those specific areas, they were able to make quick profit, which was cool. So a property that was built for or bought for $200,000 in that distressed area could be renovated and sold for $350,000 once the market started to recover, and that means you've got big profit in your pocket as opposed to what it was before. So that's pretty cool. And this is actually what my parents started to do during this time. They needed to generate additional income because the housing market in Arizona particularly was hit very, very hard. We were one of the first states to be hit by the housing bubble burst. So they figured out this is a way that we could help make our profits higher. So they would start flipping these houses and they would make small improvements. I'm not talking about like destroying the kitchen and like building it up again, but, replacing the carpet or the flooring, painting, choosing new baseboards or whatever, like little things like that to take a house and just kind of freshen it up, breathe in some new life. And this would make it more attractive to buyers. And that was a way for them to make some extra cash, and it worked out for them at the time as well as it could.
Exactly.
So how do we identify these undervalued assets, you might be asking?
Tell me it all.
Yeah, well, I wish I could. There is no secret formula. What is it from SpongeBob? Ravioli, give me the formioli, something like that.
I don't know. I just think of the secret sauce. Everyone's secret sauce, and they don't ever want to give you the formula.
Yeah, exactly. Well, there is no secret sauce because it's all just, we know with investing, there's no guarantees. We don't have a way to predict the future. So even if somebody told you their secret sauce, there's no guarantees that it would even work, right? So this process is more complex than just identifying undervalued traditional assets like stocks and bonds, because alternative investments can be more illiquid, niche, and they can be even less transparent sometimes. However, there are some things that you might want to look at or things you can do to help inform your decisions. So one of the things you can do is research the asset's fundamentals and use industry-specific metrics to assess its true value. We were just talking about real estate. So in real estate, you can use comparable property analysis, or as my mom calls comps. She's always like, pull the comps. So you can compare the property in question that you're looking at with similar properties that have recently sold or are currently on the market. And if a property is priced significantly lower, despite having similar characteristics, location, size, condition, it might be undervalued.
Or
Or
the foundation is correct.
Right. Well, this is why you get an inspection.
There's a sewer rat that lives. There's a whole like colony of sewer rats.
A rat king.
Yeah.
That lives down there.
That's why it's undervalued.
Yeah.
I'm just kidding.
Well, but that's why you get a inspection, right? So it might be that you never know. Like there are some people who just want to get rid of their house. They're done. They're over it. They just want to sell it, and they're going to sell it at a price that's really attractive because they want to be done with it. So you never know. Another thing you can do is identify market inefficiencies. This is where gaps or information gaps or emotional reactions are causing this mispricing. For example, this can happen actually in venture capital. Early stage startups may be undervalued if they have strong technology or intellectual property, but they don't have that visibility or investor confidence yet. So people don't believe in its intrinsic value. The key, though, is identifying those with solid potential but poor marketing or underappreciated value. You want to make sure the product is good.
First make sure the product's good. Then market.
We've heard about Juicero. We know about Juicero now, so let's make sure the product is good. Another thing you can do is understand economic and market cycles that may temporarily depress the asset's value. For example, with commodities, oil, gold, agricultural products that are undervalued, this may be due to that oversupply, like we mentioned, or global economic downturns. If demand is expected to increase, this may be due to a bunch of different factors, population growth, technological advances, or geopolitical changes. The asset may be undervalued. So if you foresee that the issue that is causing this asset to be undervalued should be fixed in the future, that may be an undervalued asset that you could earn some money on.
Got it.
Also, you can look for distressed markets where that temporary panic or uncertainty is causing that asset to be priced low. This is exactly like what we talked about with the global financial crisis. So what else can investors do?
So you can spot hidden or untapped value in assets with underlying potential not yet recognized in the market. So an example of this, collectibles. Certain collectibles, like we kind of talked about, rare coins, fine art, vintage cars, may be undervalued simply because the market for them hasn't yet matured. Or because they're not widely recognized.
Right.
You know, investors who can spot emerging trends in these areas can find undervalued assets. Think about like artwork, for example. Banksy comes to mind. Like there was a time where nobody knew who, well, still nobody really knows who Banksy is, but they didn't understand the artwork coming from this artist. They didn't, you know, people weren't going out trying to find Banksys. And now that they saw the value in them, everyone's looking for them.
Right. Or like Monet, same thing. Impressionists were not considered real artists.
Yeah.
And now, of course, Monet is one of the most well-known artists.
Yep.
But at the time, you know, if somebody would have invested in Monet when he was not making very much money at all and was struggling, obviously now,
look at it.
A Monet is worth lots of money.
Yeah, didn't we talk about it in our episode? I think it was 115 million Haystack sold for. I'm like,
lots of money.
I spent all my money on that painting. It's hiding in a closet. No, I'm just kidding. I wish it was. Wouldn't that be amazing? So another thing investors can do, they can use alternative valuation methods that are specific to the asset class you're investing in. So for example, storage costs and inventory levels. So for commodities like oil, agricultural produce, or products, I guess, or precious metals, look at the current inventory.
Yep.
And then the storage costs. So if the storage is high and the prices are low, it may be an opportunity to buy undervalued commodities with the exception or with the expectation of the future price increasing.
Right.
So if it's, you know, people are sitting on it, maybe it's coming back around. You can monitor inside and expert activity as well for signs that the asset value is underappreciated. Venture capital, again, if insiders like the founders, executives are continuing to invest in startups or emerging businesses, even during those tough times, it can signal that they believe that the company is undervalued and has future growth potential. In this one, it reminds me of like the app that tracks Pelosi and like Nancy's all of her stock stuff. It's like, what are they investing in? What is it called? I can't remember.
I don't know what app that is, but I think about like people are always like, what's Warren Buffett investing in?
Heck yeah. Literally got brought up this weekend. We were talking to my nephew about investing, and it's like, when he starts selling, I want to know why. When he starts buying, I want to know why.
Yeah.
And same thing with that tracker app. It's like, what are the people who have the real money investing in and why? And what are they getting rid of and why?
Yeah.
So again, those are my inside and expert activity that I can monitor. But also investors should be aware of a market sentiment and recognize when fear or greed are distorting prices. Okay. So commodities or rare assets are a great example. During periods of fear, like market crashes, geopolitical instability, investors might overreact and sell off certain assets, leading to an undervaluation. But if you can recognize that when the market is overly fearful, goodness, or pessimistic, you can buy these assets at a discount.
Yes.
So that's always a great plus.
Exactly. So we know that there's always risk when it comes to investing. And that is certainly true for those who are wanting to be a value investor. You are not exempt.
Nope.
One of the biggest risks would be falling into a value trap. This happens when an asset or stock is priced cheaply for a reason, typically due to its fundamentals being poor, and the value will not improve over time, meaning that, you know, you believe that this is going to get better and it's not. You've basically just sunk your money. So that's a bummer if that happens to you. Another would be long holding periods. Value investing often requires long-term patience. You're not investing in something that's going to turn over overnight. That's going to, you know, boom overnight. This requires time. And the market may take time to recognize the intrinsic value of the asset. So during this time, the investor might face opportunity costs, meaning missing out on other short-term investments that might generate better return because you're, you know, involved in this one that is the long-term asset or investment. So a property that is undervalued could take many years to recover its true value, during which time an investor could have taken their money and invested it in shorter term investments and made more money than waiting for this one to pop.
Yeah.
So it's just something that could happen, right?
Yeah, it is. And you know, we all love to get a great deal.
Bargain.
Yeah. But it also really does suck when you realize that you overpaid for something.
Yeah,
I
of
hate
course.
when I buy something and then like a week later it goes on sale and you're like,
Right.
dang it, I should have just waited. But it's okay. That's exactly what can happen to value investors too. So, you know, you might overpay for something and it might drop. Like you said, you lost all your money, but we're learning. We're learning, right? They can sometimes overpay for what initially appears to be an undervalued asset.
Yeah.
Especially if they misjudge its true intrinsic value or miscalculate the potential for value growth. I mean, it happens. I think all of us in life have probably had one of those purchases.
Yes. So this could happen here too.
But we all know calculating the intrinsic value of an asset is difficult, especially when it comes to alternative, because we don't know the secret formula. But inaccurate or overly optimistic valuation models can lead investors to misjudging an asset's true worth, increasing the risk of poor returns.
Yeah.
That sucks. So what did we learn here, children?
So we know that those aren't all of the risks of value investing. There's plenty more.
Yep.
But hopefully that gives us a good picture of some of the challenges that have to do with this kind of strategy. Overall, value investing can be lucrative, of course, but it requires a lot of patience and research. For those who love it, it can be a really fun way to expand your portfolio since you're essentially mining for diamonds.
Yeah.
The opportunity is going to take off like a rocket and generate significant return. That's your hope, right?
Yeah,
Or it's like thrift shopping, you know, and it's like the thrill of the hunt. So if that's your style, like this might be a good option for you. It might be fun.
I agree, because great deals often hide in plain sight.
Yep.
Right? You know, so it's just how you analyze the risk and the timing to make sure that you make it right for yourself. Undervalued doesn't mean cheap either.
Yep, true.
It just means it's underappreciated for the time being.
Right.
Alternative investing is about seeing the potential before everyone else does. So if you can stop the investment early, you can win big.
Yeah.
Or not stop it, spot it. If you can spot it, we don't want to stop investing.
We don't want to stop the investment.
Always invest with your research.
We want to spot it though.
Spot it. And then it could be, you know, who knows? Like I said, you might take that one piece that you found at a garage sale and take it to the Antiques Roadshow and make a ton of money. Anyway, on that love note, thanks so much for tuning in today, and we hope to see you next time.
Thanks for joining us. Stay tuned for more insight on our next episode.
And don't forget to subscribe to continue the Alternative Investments chat. See you next time.
Content provided in this podcast is for informational purposes only and should not be construed as professional, financial, or investment advice. This podcast should not be construed as an offer to sell or a solicitation of any offer to buy any securities. We strongly recommend that you seek advice from a qualified professional before making any financial decisions.